Good afternoon, everyone. I believe that you all must have been studying very hard for your examination, which is about to come in January 2025. I am C. Ankit Sharma, your income tax faculty for today's session, and today we will be discussing chapter number 9. That is our last chapter, the income tax. That is calculation of total income and your tax liability. So this is a chapter which comprises each and everything which is related to computation or finding of a residential status. This chapter covers from chapter number 1 till chapter number 8 all provisions. So this is very, very important. It's a kind of a chapter which is definitely covering each and every topic what we have already gone through in these last classes. So good afternoon, everyone. Once again, I welcome you all in our class, revisionary class for January 2025. Okay, the messages are from Bhumika. Okay, Bhumika is asking something. She's asking, sir, what is difference between deduction under section 80C or deduction number 16 on page number 6.15 and 80EE and 80EE? First of all, Bhumika, we have already covered deduction topic earlier, so you should ask these kind of question. Those are related with our topic. But for the time being, I can tell you, Section 80C talks about principal amount repayment. Section 80C talks about if you have taken a housing loan and you are paying EMI, then that EMI comprises principal amount and interest portion both. So 80C only talks about deduction for the repayment of that principal amount. 80C for the repayment of principal amount. The balance part which shows interest portion can be claimed under income from house property, as well as if it is more than 2 lakh rupees, then you can claim that under section 80EE. If that loan has been sanctioned in, I guess, previous year 16-17, we have discussed those topic in detail. And if that has been sanctioned after that, then we can claim if we fulfilling the other condition of section 80EE, then you can claim that interest portion. So the basic difference is 80C talks about the repayment of principal amount, and 80EE and 80EEA, they both talks about the interest portion deduction in these sections. Okay, so I hope it's clear. Shoaib is asking, sir, may I ask a question? Yes, Shoaib, you can ask. Till Pooja, good afternoon. Satyapriya Nayak, good afternoon. What do you want to ask? Shoaib, you can ask. Shoaib is asking, sir, if dividend amount is given in profit and loss account with the gross amount, so can I deduct TDS while putting it in income from other source head? No. Technically, imagine yourself as an assessee. So if I received 5,000, 10,000, 50,000 rupees as dividend, and it has been written in the credit side of our profit and loss account, and it has been written gross TDS or gross dividend received, then we cannot deduct our TDS. This is the responsibility of payer to deduct the TDS. We can only do one thing. We can include that dividend amount, gross value in our income from other sources, and we can pay the tax, whatever it will be, on that dividend portion. We cannot deduct TDS. A payee technically cannot deduct TDS. Only payer can deduct TDS. So you are going to include the full value in income from other source on which you can pay tax, normal tax, whatever it will be on that particular income or upon your total income. Clear, Shoaib? Okay, good. Any more queries? If there is no more queries, then we are going to start our topic today. And in this topic, we have two classes. First is today, 21st of November, and the other class would be on day after tomorrow, that is on 23rd of November. Today, we will discuss the theoretical part. We have some special provision revision like AMT, alternate minimum tax, and we will comprise all the topics from like there are total 15 steps to calculate income tax on a particular income. So one by one, we will discuss those topics that already has been discussed through our revisionary classes or our normal classes. So those are chapter like residential status, like basic concepts like salary head of income, deduction, clubbing provision, etc. So after all those 15 steps, if we are completing, then we are able to solve a question in which we have to calculate our total income and the tax liability upon that income. Okay, so get set go. That is chapter number 9. That is income tax liability, computation, and optimization. We have three different topic also that we will cover in this topic, and that is AMT as I've discussed, and salary structure, or to finding out the optimum salary structure to minimize our tax liability. So to find out the tax on an income, a very interesting thing is there. It's not that easy. So in a question in which you need to calculate the income and the tax, a very interesting thing you should keep in your mind that the tax liability question, first of all, we have to find out the requirement of the question. This chapter number 9 topic, in my opinion, would be the first and compulsory descriptive question. Might be it will be about like 15 marks or 12 marks. So that would comprise a lot of marks. So before reading the question in starting, you have to find it out what is the requirement of the question firstly. So the requirement could be that you only need to calculate total income or tax. It might be possible they are asking you to calculate only under default tax regime or optional tax regime, or might be possible under both regime, or even there could be a single line which says calculate tax with most beneficial manner. So if they are writing this word in most beneficial manner or to minimize this tax liability, so that means you have to calculate tax as per default tax regime as well as the optional tax regime, and there would be a AMT concept also. How AMT is going to affect your solution, let me tell you how this is going to affect your solution. So technically the tax liability, if the question asks to calculate your tax liability, then it would be like this: calculate tax under section 115 BAC, that is under default tax regime. So there would be a tax as per these provision. So to finding out the tax as per section 115 BAC, you might need to calculate firstly the gross total income as per section 115 BAC under different sets of income. Then you might need to apply deduction provision. Only 3 deductions are allowable there. And then need to calculate the tax as per section 115 BAC. So there would be a tax as per section 115 BAC, but there is a lot more to come. The other part will be tax as per normal provision. If there is tax as per normal provision, then there would be 2 calculation of tax is possible. First is as per optional tax regime. So again, in this optional tax regime part, we have to calculate GTI as per optional tax regime provision, then respective deductions we have to apply, and there would be a tax. We can name it tax A, we can name it tax B. But now there's a new concept also that is called AMT, alternate minimum tax on other than corporate entities. This AMT concept is applicable on other than corporate entities, because for cooperative entities there is MAT, and MAT is going to be discussed in final level. So other than companies, there is a concept of AMT provisions are there. So if your adjustable total income that we call ATI is exceeding 20 lakh rupees, then we have to apply AMT provision in respect of individual, etc., individual, HUF, etc. And we need to calculate a tax. We will discuss the AMT provision in this revisionary class also. And now we have to calculate a tax that would be called AMT tax, and that is called tax number C. Now, what should be our tax liability? What is going to be my final tax liability So between comparison between tax A and tax C, the higher would be qualified from both of these. And the higher value need to be compared with. Please remember there is no concept of AMT under section 115 BAC. Okay, we have already discussed this in our normal class that there is no concept to calculate AMT under section 115 BAC. So if the question asks you to calculate only tax as under default tax regime only, there is no question is not asking you to calculate tax under both regime. The question is not asking you to calculate the tax minimum liability. The question is not asking you to calculate tax in a most beneficial manner. And if there is only one requirement to calculate tax as under default tax regime, then this will be your answer. This will be your answer, final answer, and that is it. But if the question is asking to calculate tax liability under both regime, or most beneficial to the assessee, or to minimize the tax, in that case, we have to follow step number one, this. After finding out tax A, B, and C, the step one is to finding out the higher of tax between B and C, and then we need to compare it with tax number A. Now, whichever is lower between A and this higher value, that lower will be my final tax liability. This need to be paid. This need to be paid. And the respective income will be set my total income. Suppose if this A is lower, then A would be my final tax liability, and whatever income we have found out as TI in this A category would be called my total income. If the higher value is this, if the lower value is this B part, then that will be tax liability, and the TI which belongs here will be called my total income. And the same, if the lower value is tax C, then that tax C will be my tax liability, and the respective ATI will be called my total income. Clear? If the tax paid lower value, if is AMT, if the lower value comes out as AMT, that means tax C is the lowest value. After doing all this step, then we will have one thing that is called AMT credit, which we can utilize in our future tax liability. What is this AMT credit? How we calculate it? How we are going to use it? What is the time limit to use it? That we will discuss in our revisionary AMT provision. But whenever there is a question in which you have to calculate or you are asked to calculate your tax liability, then step number one, you have to calculate tax as under default tax regime. Then you have to calculate tax as per B and C, one under optional tax regime, and then maybe as per AMT if AMT provisions are applicable. The higher of B or C, first we have to find it out, and then that higher need to be compared with tax A. The lower would be your final tax liability. Understood? So that's why the question comes for 15 marks, because generally they ask the both tax regime, or generally they just ask in a single line, calculate the tax most beneficial to the assessee. So in that scenario, technically you have to calculate three taxes: default, optional, and AMT tax. So that's why a single question comprises each and everything: the deduction concept, the tax calculation concept, the other heads of income, clubbing, set off, TDS, advanced tax, etc., etc. Okay. So let's discuss one by one. You can see that is computation of total income and tax is not an easy task. Technically, after introducing the default tax regime, everything is going to be more complicated because the calculation has been enhanced. So we have to find out the GTI, the deductions. After that, we will find out our income, tax as per normal provision, tax as per section 115 BAC, AMT tax, etc., etc. Fine. And you will see the majority part of this chapter has already been discussed in our various topic. So it is a summary chapter which includes certain new provision, that is one is AMT and the other is regarding structure of a salary, optimization of your salary structure. These two topics are new, otherwise each and everything we have already discussed in our normal life classes also, and in our revisionary classes also. So this chapter is going to be a revision of technically all the chapters together. And I have asked you in our last class that please, when we will take class of this chapter, you must have revised the provision of basic concept. You must have gone through with the PGBP topic, and you must have provisions need to be remembered. So if you are able to remember all those provisions, then in that situation, this chapter will be easy for you. So the basic concept topic and the PGBP topic need to be revised before revisioning of this topic over here. So that is determination of residential status. First, we have to do all that thing. Then classification of income like salary, house property, PGBP, capital gain, etc. After finding out the income under each head of income, we have to apply the respective exemption deductions over there, clubbing provision, set of provision. That will be my GTI. Less deductions, and then we will find out our total income. If you remember, if any of you have remembered, the same kind of format or table was in chapter number 1, that is what basic concept. And at that time, we might feel what is clubbing, what is set off, etc. Because at that point of time, we have not gone through with the provision of clubbing, set off, etc. So these terms are very new for us. But because this is the right chapter in which we can summarize all these things together, and because we have already gone through with each and every chapter, so now we are all aware what exactly the meaning of set off, why there is clubbing, what is deduction, etc. So that is a better chapter in which we should summarize each and everything what we have already discussed in chapter number 1. So meaning of total income, no need to discuss all these things because we already know what is the meaning of total income. So if after subtracting of deductions on the chapter 6A from our GTI, the result what we got, that is called our total income, and tax need to be charged on total income. So you can call it total income, taxable income, income chargeable to tax, etc., etc. Income to be considered while computing total income of individual. Of course, general provisions are there. We know each and everything, whatever written over here. Computation of total income and tax payable by an individual. So income tax levied on an assessee's total income. Such total income has to be computed as per the provision contained in the Income Tax Act 1961. Step 1 to 8 here under have to follow for computing income, and then step number 9 to 15 for calculation of tax liability. So there are almost 15 steps to find out our tax liability, including the AMT provision, etc. Determination of residential status. We have already gone through with this topic. There could be 3 categories of residential status. Either it could be a resident and ordinary resident, or it could be a resident but not ordinary resident, or it could be a non-resident. Okay, we have gone through with the provisions, so not going to revise these topics. Then after finding out the residential status, the second step is to calculate the income under various heads, or to find out which income need to be classified under which head. So if there is an income from your employment, that would be your salary income. If that is a rental income or income from a building, that would be an income from house property. So on, if there is a business profession, that would be your PGBP income. If the income is from an asset which is transferred, then it would be a income under the head capital gain, and all other income which do not form part of these 4 heads will and be chargeable to tax. Those are going to be taxed under income from other source. So these are salary, capital gain, PGBP, etc. We have to follow certain provisions under these heads of income, and then we step number 3 talks about computation of income under each head. After classification of income, we have sorted that which income need to be shown as salary income, which income need to be shown as business income, etc. So after we have sorted it, we have classified it, then we have to calculate income as per the provision, as per the respective deduction in those chapter, as per respective exemption. As in capital gain, there is section 54 exemption, etc. Shoaib is asking, sir, if in question is asking for normal provision, only then AMT is also required to calculate? Yes. So if the question asks you to calculate tax as per optional tax regime or as per normal provision of tax, then we have to apply AMT provision. So if the question is asking you to calculate tax as per default tax regime, there is no need to apply AMT provision in that case. Okay. So computation of income under each head of income. We have discussed that. Like under salary, there are certain exemption like allowances exempted, children education allowances, etc. So we have gone through all the provision. No need to rediscuss that. Then the fourth step is clubbing of income of spouse, minor child, etc. So in that clubbing topic revision, we have gone through with these provisions also, that how we need to club the income of a minor child, etc. or a spouse or other persons. That is revocable transfer, irrevocable transfer, and so on. Then we have set off and carry forward and set off of losses. In case of set off or carry forward and set off of losses. So if I ask you that how many types of losses are there? How many types of losses? So it's a very interesting question. How many types of losses are there for the purpose of carry forward and set off? So how much losses we will say? Listen carefully. I am not asking nature of losses. I am asking you kindly tell the types of losses on the basis of their carry forward provisions. The different kind of losses on the basis of their carry forward provision. There are technically 7 cases of losses. I am asking as I used to draw the format. Like in the business head, we have 3 types of losses. Speculative, having separate provision. Section 35 AD business losses having separate provision, and other business. There are 3 category of losses under PGBP head having different provisions for set off and carry forward, because speculative losses cannot set off any other income except speculative gain. Same in case of section 35 AD, but other business can be set off. So technically we have 3 types of losses provision, 3 types of losses, different type of losses provision under PGBP. Same in case of capital gain. We have long term and short term. So long term cannot set off from short term, but short term can set off from long term income. And the capital gain losses cannot be set off from any other head of income. So technically, capital gain having 2 nature of losses. One is long term having separate provision, short term having separate provision. Then we have income from house property losses. It is a single type of losses. The provision is this, that you cannot set off more than 2 lakh rupees losses from other head. But under intra head, under the same head of income from house property, there is set off is allowed. So there is no restriction on setting off of losses from rental losses to house property or houses to self-occupied to rental. There is no restriction. So this is 6 kind of losses. And which would be the 7 type of losses? Having separate provision, which is the 7th one. 3 in PGBP, 2 in capital gain, 5. 1 is house property. And what is the 7th one? Having different set of losses provision from others. Which one is the 7th one? Kindly answer. Depreciation is not a loss. It's an unabsorbed depreciation, Arun. We cannot call it loss. Yes, Bhumika is correct. Losses from not horse race, it's a wrong interpretation. The correct is owning and maintaining horse race. If in the examination it has been asked, and your intention is correct, you know that you are trying to writing up the answer of like maintenance of horse race. But if somebody used losses from horse race, that would be treated as a casual income horse race. You need to explain. So you should very careful whatever you are thinking and whatever you are writing. In some cases, it happens that you try to write the same thing and you're imagining that you are writing up the same thing, but that will not going to explain that thing to the examiner. So he won't give you marks. Again, Somebody else also write the same thing. That was Satva Priya. Income from other source, horse race. Do not write like that. It would be like owning and maintaining horse race losses. Okay. So yes, that is the seventh one. It has that loss having separate provision to carry forward and set off. Well done. Now after step number 5, we will be at our GTI technically. So that what intra head, inter head, etc. Carry forward provision. After doing this provision, now we will arrive at our gross total income. And gross total income means all heads of income total, applying clubbing provision, applying set of provision, and after that, whatever we will left with, that will be called my gross total income. After the gross total income, now the role of deductions comes into the force. And there are multiple deductions on the basis of payment or investment, on the basis of income, other deductions. Those deductions allowable under section 115 BAC. Only there are 3 deductions which are allowed under section 115 BAC. Kindly explain those 3 deductions which are allowable under section 115 BAC. Who will tell me the answer? Those deductions, those are allowable under section 115 BAC. Only 3 deductions were allowed under section 115 BAC. Bhumika is saying correct. 80 double J double A is one. The second one. 80 CCH, correct? And 80 CCD2. Well done. Very well done, Arin. Correct. So 80 double J double A, that is for new employment. 80 CCH, that is Agnipath scheme. And 80 CCD2, that is employer contribution for NPS. Very well done. So after applying those deductions, we will arrive at our total income. So deductions, there are multiple deductions on the basis of payment, on the basis of certain incomes, on the basis of respect of other income, like that is respective income from other sources, and other deductions like ATU, etc. We have also section 10 AA, that is for special economic zone provision. You can also going to claim it, but under section 115 BAC, you cannot claim section 10 AA deduction. So that is very important to remember. When you are solving a question, you might be able to solve section 10 AA, but remember that is not allowable if you are going to calculate section 115 BAC tax liability, etc. Then we will find out our computation of total income, because if we deduct out of our GTI deductions under chapter 6A and section 10 AA, then we will arrive at our total income. Remember, the total income should be rounded off to the nearest of multiple of 10 rupees, and so on. The tax should be rounded off into the nearest of multiple of 10 rupees. So after the calculation from step number 1 till step number 8, we have calculated our taxable income, total income, or we can call it income chargeable to tax. Now from step number 9 till step number 15, we will see how to calculate tax. So there would be a calculation of tax as per section 115 BAC. There would be a calculation of tax as per optional tax regime. There would be a calculation of tax under AMT. There would be a surcharge provisions for the purpose of different types of scheme. There would be cess applicability for all kind of taxability. There is cess is the universal thing. Whether it's section 115 BAC, optional tax regime, or AMT, cess is universal. That is 4%. In each case, if there is a tax, there would be cess of 4% in each cases. So cess would be there. Then there is advance tax, etc. And then there is last is recovery of tax, etc. So step 9 talks about calculation of tax under section 115 BAC. So after finding out our total income, taxable income, now we have to apply the tax rates to find out the tax liability on that income. So concessional rate of tax structure, we have already gone through. The slab rate in chapter number 1, that is basic concept. Up to 3 lakh rupees, it's nil. From 3 to 6 is 5%. 6 to 9 That would be 10%, 9 to 12, 15%, 12 to 15, 20%, and above 15, it would be 30%. We have special rate of taxes also for certain categories of income. And that special rate we have already covered under capital gain, under section 111A, that is 15%. Under section 112, long-term capital gain, it's 20%. Under section 112A, long-term capital gain, it would be 10%. For casual income, that is going to be 30% tax liability. So those four are a special rate of tax liability income. Other than these four incomes, the income is going to be taxed as per these slab rate of tax in case of individual, HUF, etc. Clear? Tax rate prescribed, and this is optional tax regime. We all know there is an exemption of 2,50,000. And if you are a senior citizen, that would be 3 lakh. If you are a super senior citizen, then it would be 5 lakh rupees. And after that, there is a rate is 20% and the rate is 30%. There are multiple surcharge provision in different circumstances that we have already gone through in our basic concept topic. So we have a special rate of income also over there. You can see that. So there are special category of rate of taxability of income. The rate under section 112, 115BB, 115BBJ, etc. These are casual income having rate of 30%, 112A having 10%, 112 having 20%, 111A gains short term is 15%, 115BB and BBJ, these are casual income having tax rate of 30%. Okay, we have gone through with this provision. After applying tax rate, then surcharge would be there. And surcharge provision also we have gone through in chapter number 1 in detail. The maximum surcharge rate in default tax regime. What is the maximum surcharge rate under default tax regime? Who will tell me the answer? Ranjan is saying 25%. Everybody is saying 25%. Well done. And what is the maximum surcharge rate under optional tax regime? It's 37%. Well done. Correct. So those surcharge provision will vary depending upon the category of income. We have gone through with the chart also. If you want, I can show you that chart again. So this is the chart regarding the surcharge applicability provision. And this is very simple. Case number 1, there are 4 categories of special income. So if your total income does not consist section 112, 112A, short-term cap gain 111A or dividend. So if your income does not consist these income, any of these income, then surcharge would be as follows. If total income exceeding 50 lakh up to 1 CR, that is 10%. So there is no surcharge if your total income is less than 50 lakh. Clear? So between 50 lakh and 1 crore, it's 10%. Between 1 crore till 2 crore, it's 15% of tax. More than 2 crore up to 5 crore, it's 25% on tax, and more than 5 crore, it would be 37% on tax. It is when you are not following default tax regime. So if you are following optional tax regime, then these are the surcharge rate. If you do not have income from 112A, 112, 111A and dividend. Case number 2, of course, the opposite of this case. So that means if we have income from any of these kind of income or all of them, then surcharge provision will change in 3 different scenarios. Scenario 1 talks about if total income including 112A, 111A, 112 and dividend is up to 2 crore. So that means automatically that it is exceeding 50 lakh, but it's up to 2 crore. Because even if after including these 4 incomes, if total income does not exceed 50 lakh, then there would be no surcharge. So after including these income, if your income is up to 2 CR, then surcharge would be like this. If total income exceeding 50 lakh up to 1 CR, if its income more than 50 lakh up to 1 CR, then whatever tax will be calculated on these all income, your normal slab rate income and these special income, whatever is your tax, the surcharge rate would be 10%. Whether dividend is included, 112A, 112, etc. Whatever will be the tax, because in section 112A, 111A or 112, different tax rate would be applicable. So whatever tax on these income with special rate of tax and on other slab rate income, whatever will be the tax, the surcharge rate would be on that tax constantly. No separate bifurcation for surcharge on special rate category of income or not, because income is up to 2 crore. So if the income is up to 2 crore, there is no differentiation of surcharge between these special category of income or normal. Whatever will be the aggregate tax, the surcharge would remain the same. And it would be like same, like if more than 50 up to 1 CR, 10%. If it is more than 1 CR, it would be 15% up to 2 CR. Now, if after including these income, your TI exceed 2 CR or 5 CR, then surcharge provision would be similar for all. Again, it would be 15% on full tax. The surcharge provision will be changed only if C category provisions are applicable. Only if C category provisions are applicable. Only in that case, the surcharge provision would be changed. Because in this category, the surcharge rate on a special category of income, 112A, 111A or 112 would be different. And on other income, it would be different. Now, third category provision says, the C part says that you have income. You have income from section 112A or 112 or 111A. You have that income in your income. But your other income, after excluding these four income, your other income, like income from house property, business, salary, that is exceeding 2 crore rupees. Without including these income, if your other income is exceeding 2 crore or 5 crore, then C case would be applicable. And in this case, surcharge rate would be changed in this category of income and in other category of income tax. What would be the surcharge rate? On 112A, 112, 111A, etc. tax, 15% surcharge will be there, whether your TI exceeding 2 CR or 5 CR. On other cases, if it is exceeding 2 CR but up to 5 CR, then surcharge rate would be 25%, or if it's exceeding 5 CR, the surcharge rate would be 37%. So this is, I am discussing with you to just revise the provisions, because we are going to calculate tax in multiple questions. In MCQ, all the questions are numerical. You must have a paper, pen and calculator, because each question having calculation. And at that point of time, when I will apply the surcharge provision, so you would understand automatically that why I'm applying that percentage, because that percentage belongs to our these provision. There were questions also, examples also, what we have discussed in last class. Now the default tax regime and the normal optional tax regime is having only one difference, that under default tax regime, there is no 37% category of surcharge rate. So even if your income exceeding 5 CR or exceeding 2 CR, the surcharge rate would remain 25%. Even in this case, even if it's exceeding 2 CR or 5 CR, does not matter, the surcharge rate would remain 25%. Clear? So that was the surcharge provision. Going back onto the provisions, what we were discussing. So it's a very complicated question, that is what we should apply. From the point of view of assessee, it's very difficult that should I go for new tax regime or should I opt for old tax regimes. Here, old tax regime is optional tax regime technically, and new tax regime in this scenario is technically, we are talking about section 115 BAC. This is new tax regime in this picture. An old tax regime is optional tax regime. So being a assessee, we have to decide which we should follow. And you can see, if you are comprised the provisions of, or even if you are thinking about the provision of chapter 1 till chapter 8, just try to imagine that the first thing an assessee should know. It is not that simple that an assessee can find out which option should be better on the basis of rates of tax. No, not the rates of tax is on the only criteria. There is more things, like if you are a salaried person, which exemption you have to leave if you are going for under default tax regime. You should know that. It is not only the rates, it's a very complicated provisions. Suppose you thinking that rates of tax are is less in default tax regime because up to 7 lakh we do not need to pay anything. And under optional tax regime, only 5 lakh is exempted. But under optional tax regime, we have benefit of allowances, multiple allowances. Under salary topic, we have deduction set off of losses of house properties there. We have deductions under PGBP, section 35 AD, section 10 AA, multiple deductions 80C to 80U, which we are going to which we are going to lose if we opt for default tax regime. So this is not the only criteria that we are supposing that the tax rates are lower in optional tax regime is higher than comparative to default tax regime, or even vice versa. One should know all the provision, or one should calculate all the provision before arriving at the decision. It's like a chess game. If someone of you aware of a chess game, it's not the move what we are actually going to do in our next attempt. It's all about thinking the whole scenario, that what will be the impact if I move this in my chessboard, what will be the response from the other competitor, and after that what should I respond. So just the player, the chess player, those are at the top level, they just do not see the one step what we are moving in the game. They technically calculate almost future 15 or 20 steps before they just start one of their pieces in that chess game. So in that the same case, from the point of view of an assessee, you can imagine how difficult part is this to take a decision what we should choose. So that's why they comes to us. The assessee won't be able to do all this calculation because he knows that he won't be able to find it out what is exactly the benefit. It's not only the tax rate, let me tell you. It's a huge and complex procedure. So that's why they come to us. They pay us fees to calculate. And again, we are also discuss each and everything, whether you are a resident, non-resident. So those step 15, what we have gone through, technically we have applied. Technically, we need to apply all those steps in our practical life also. So once an assessee comes to me, and if I need to find it out, what structure should be beneficial to him. So I have to take the step number 1. I need to confirm whether he's a resident, non-resident, what is his salary structure, what are allowances is, what are clubbing concept, what are business provisions he's following, what are the deductions, what are his investment, etc. And after considering all these things, then we are able to find it out that whether he should opt for optional tax regime or section 115 BAC. That's why we charge fees, because the more complex will be the law, the fees would be higher. Okay, so that's a good thing also in another scenario. So in case the assessee pay tax under default tax regime, there are surcharge provision, and we already gone through with the surcharge provision with the help of the diagram, of course. And we have surcharge separate provision if you are not going for default tax regime provisions. Now the rebate concept also, yes, I also forgot that the rebates concept is also there. In case of optional tax regime, the rebate is 12,500 rupees. Up to, if your TI is up to rupees 5 lakh rupees. So if your TI is up to 5 lakh rupees, then whatever is your tax liability, that would be allowed a deduction of a rebate, that is 12,500. So if I say that under optional tax regime, under optional tax regime, if I write this statement, so you have to tell me, is it correct or incorrect? Okay, I am writing a statement. Suppose I am writing this statement that is under optional tax regime. There would be nil tax always if TI is up to 5 lakh rupees, if assessee is an individual and resident and age less than 60 years. So is this statement is correct or incorrect? With reason, you have to give me the answer. Suppose this kind of question is asked in your question paper for 2 marks. So what would be the correct answer and with reason? You can give me the reason in short, there's no issue. But first of all, you have to tell me whether it's correct or incorrect, and then give me a single reason in a single sentence why you have given that particular answer. Clear about the question? Karen is saying correct after rebate. Okay. Joy is saying if income comprising of special income, then a statement is incorrect. Okay. Pooja is saying no, because there can be an income under section 112A. Okay. CG Anagha is saying, Anagha, okay. Incorrect. There will be tax as the income might include income from. Okay. Anyone else? Only Arun is saying this. The statement is correct. Now Arun is again saying incorrect. Okay, you have changed your answer. Well done. So why is incorrect, Arun? First you have given me the answer correct, and now you are saying incorrect. So why it was incorrect now? 112A. Okay. Yes, of course, that's an incorrect statement. Because suppose if I have income of 5 lakh rupees under section 112A or section 112, the tax rate is 20%. The tax rate is 10%. Or 111A, the tax rate would be 15%. Then the rebate provision says you can get the rebate if maximum up to 12,500 rupees. Suppose you have casual income. In case of 112A, you cannot claim the rebate. If you have casual income, then your tax liability would be 30%, 1,50,000, and you can only claim the rebate of 12,500 rupees. So it is incorrect in case of special rate of income is there, because it is not a provision. If government intention was like this, that government want to exempt your tax up to rupees 5 lakh, then there would not be a rebate. There would be a provision like no tax or income would be exempted up to rupees 5 lakh. So government provide a rebate. That's why that in normal or optional case, normal rate of tax or slab rate tax income cases, you are not liable to pay taxes. But if there is special rate of income, there definitely could be a tax, even if your income is up to rupees 5 lakh or less than that. Correct, Bhumika. Okay. Understood? Fine. And in case of section 115 BAC, there is a rebate of 25,000 maximum. If your TI is up to rupees 7 lakh, but there is a catch also. in case of section 115 BAC, that if your total income exceeding rupees 7 lakh, and if the tax upon that total income exceed the income which is in excess of 7 lakh, then you can get a rebate kind of marginal relief. Aranjan, yes, we would not call that marginally. We will still call it a rebate, but the concept is just like similar to the marginally provision. So always remember that the provision says up to rupees 7 lakh, but not in case of this. So these are the rebate provision. Rebate under section 87A. Section 87A provides a rebate from the tax payable by an assessee being an individual resident in India. If total income of such individual does not exceed 7 lakh rupees, the rebate shall be equal to the amount of income tax payable on his total income, or the tax whichever is less, 25,000. No problem till here, but the second point started a new controversy, or we can say second point started a new complex situation. If total income of such individual exceeds 7 lakh rupees, and income tax payable on such total income exceed the amount which the total income is in excess of 7 lakh, the rebate would be as follows. So similar provision like marginally. Step 1, you have to calculate total income minus 7 lakh rupees. You have to find out that difference. Then calculate tax on that income which has been given in question. And if that tax is exceeding the difference in step number 1, which is A, that difference would be your rebate under this section. How we will calculate it? We have several examples for that. I will show those examples one by one, so we are able to solve them. So we can see as per question number 1. Suppose the total income is 7 lakh rupees. Then we can get the rebate of 25,000 rupees completely. There would be no tax liability. Clear? Then suppose the income is 7 lakh 5,000 rupees. So as per the provision, the income is 7 lakh 5,000. So step number 1 say 7 lakh 5,000 minus 7 lakh. So we have a difference of 5,000 in this scenario. Then step number B says need to calculate tax on this income, which has been given in question. Tax on 7 lakh 5,000 would be 25,500. So now B is more than A. B is 25,500 and A is only 5,000. So now difference will be your rebate. Difference would be 20,500, like a marginally. What we will do with this difference? We deduct this difference from our tax liability. This 25,500 minus the rebate 20,500, that would be my tax liability 5,000. You can see like this. In the second case, it's 7 lakh 10,000. So the difference in point number A would be 10,000. As simple as that. The tax liability on 7 lakh 10,000 would be 26,000. So B is more than A. How much? 16,000. So the rebate would be, you can see 16,000. Deduct this 16,000 from the tax liability. So difference would be my tax. 10,000 would be the tax. In case of 720, example number 4. Now you can see the difference is 20,000. Now tax on this 720 is 27,000. B exceeding A by 7,000. That would be my rebate. Deduct this rebate from my tax liability of 27,000. Balance would be my tax. That is 20,000. Now if it's 7 lakh 25,000. Now, difference of A is 25,000. B, that means your tax liability. The tax liability is 27,500. So B is exceeding A by 2,500. That is my rebate. You can see that. And rebate deducted from tax liability, that would be my final tax liability, 25,000. Now 6 point says the income is 7,27,780. The excess of A is 27780. And the tax on this would be 27780. So that is zero rebate would be there because difference is zero. So full tax you need to pay. So this is the last amount of income we can say. After this, there would not be applicability of this rebate. After 7,27,780 rupees, there would not be technically any rebate available. So in case of 730, you can see now B is not greater than A. From point number 7, A is greater than B. So there would not be any rebate. So full tax liability would be as your tax liability. I hope it's clear. Moving on further. In case of normal case, it does not matter if you have income exceeding, like if you have income of 5,10,000, there would be no rebate. If your income is 5,200,000 rupees, there would be no rebate. So we have seen different tax structure in case of default tax regime and optional tax regime. We have seen different surcharge provision in case of optional tax regime and default tax regime. We have seen rebate provision in case of optional and default separate. Step number 11 is the universal rule regarding the cess provision. 4% cess of health and education cess need to be applicable. Earlier it was like this. For higher secondary, it's 2%. No, for secondary, it is 2%. For higher secondary, it's 1%. Earlier it was 3% for education cess. And then health cess 1% also imposed. So now total cess would be 4%. That would be called health and education cess. That is 4% on your tax liability applicable on each and every one. Similar provision. Now comes here the AMT concept. How to calculate AMT, and we have gone through with the provision in detail in our normal class also. So we just going to revise certain important concept in this AMT provision. These are applicable on non-corporate entities only because for corporate entities, there are concept of MAT, minimum alternate tax. And this is alternate minimum tax. Okay, it could be like this: minimum alternate tax on companies, minimum alternate tax for other than company. They could do like this also, but they say no. We will just jumble up these words, and earlier it was MAT, now it would be AMT. Okay. There could be a future in case it will be TAM, tax alternatively minimum, or there's TMA, tax minimum alternatively. It could be like this also in some other cases. So the Income Tax Act 1961 contains profit-linked and investment-linked deductions in order to encourage investment in various industries and infrastructure facilities. So due to the benefit of Section 35 AD, Section 10 AA, you can understand that those entities, those are taking the deduction of Section 10 AA due to export turnover. So they are not poor industries, or they are not like this, that they are not able to pay tax. So these industries could be in highly profit margin, but due to the benefit provided by the income tax department, it might be possible that they are not technically paying any tax due to the benefit they have taken under Section 10 AA, Section 35 AD, etc. So what will happen if an entity is technically exporting each and everything, 100% exporting in a special economic zone? Then for starting 5 years, then again 5 years, then again 5 years. So technically for next 15 years, they are not going to pay any income tax due to the benefit of Section 10 AA or For first 5 years, they will not pay any income tax. And then further, they won't pay on 50% of income tax. But they are highly profitable companies. And those entities should pay tax because income tax is a progressive tax. This is the sentence we generally used regarding income tax, that income tax is a progressive tax. What is the meaning of progressive tax structure? What do you understand with this statement? Suppose in the examination it has been asked, income tax is a progressive tax. Explain in 2 marks how you will understand this concept. What is technically the progressive tax? Correct, Bhumika is absolutely correct. Well done. Tax increase as income increase. Shoaib is also correct. Higher the income, higher the tax. So if you progress, if you earn more income, then you have to pay more taxes. If you have low income, you have to pay less taxes. If you have income less than 5 lakh rupees, so might be you not need to pay any taxes. So as the income arise, the tax structure will grow. So that's called progressive tax structure. This is not in case of GST. If I'll ask you whether GST is a progressive tax or not, the answer would be no. Why? Why GST is not progressive? Why? What is the reason behind it? That GST is not progressive tax structure. Income tax is a progressive tax structure because India is a democratic country, so progressive tax structure is better than normal tax structure. But GST cannot be progressive tax structure. Why? In comparison to income tax. Because even in case of GST, if a rich person purchases a chocolate of 100 rupees, he has to pay GST with the same rate. And if you're a medium class person going to purchase that chocolate, even he needs to pay exactly the same rate of GST. And even a person who is a very low income person going to purchase that 100 rupees chocolate, or even that 10 rupees chocolate, or even anything 5 rupees. So even if you are purchasing a 5 rupees items, then it does not matter whether you are a very rich, you are a rich, you are a medium, you are below poverty line, it does not matter. All needs to pay same rate of taxes in case of GST. That is not a progressive tax structure. So, okay, stick on to our income tax topic. So technically income tax is a progressive tax structure. So we assume that those industries, those are earning huge profit, should contribute to the country in the form of income tax, but because they have the benefit of tax structure. And why they have that benefit? Because government provide those benefit to them to development of certain area. If government wants to develop certain kind of area, they need industry there, but nobody will uh, going to use that area for their industry purpose. But if government provides these kind of benefit, that if you will going to establish your industry in that particular area, you need not to pay any taxes for next 15 years because we are declaring it as a special economic zone. And what will happen? The new industries will start opening in that area, and due to that, the infrastructure of that area will grow. Like you have seen Noida, Gurgaon, etc., Haridwar, government try to develop areas by providing these kind of benefit. But there's a reverse problem with government. Those industry, those established there, would not be able to contribute in income tax for maybe next 5 year or 10 year or 15 years. Same in case section 35AD, there are multiple business for which government provide deduction section 35AD because those business like hotel, hospital, warehousing, etc. going to contribute in the infrastructure of our country. But because they will be allowed a reduction of 100%, earlier in some cases it was 150% of investment. In case of some industry under section 35AD, it was not 100%, it was 150%, but now reduced to 100%. So they will claim 100% reduction in the year of opening of business. So what will happen? There would be huge deduction in the first year of business. So due to that deduction in first year, they might not going to pay any taxes in future 5, 6, 7, or 8 or 10 years. So again, that they are able to pay tax, they are profit generating units, but due to this benefit of deductions or exemption, they won't pay anything. So government started a provision of AMT. Okay, as per income tax, you won't be able to pay anything as a tax structure. And tax structure is high also, like 20%, 30%. But we are going to charge something from you by applying the provision of AMT. Under AMT, there is no benefit of section 10AA. There is no benefit of section 35AD deduction, almost like section 115 BAC provision. Some deductions are also not allowed, etc. And section 115 BAC similar provisions are there. But in section 115 BAC's tax structure is high because the slab rate would go to 20% or 30%. After crossing 15 lakh, it would be 30%. But under AMT, the tax structure is fixed, and that is 18.5% tax of your ATI. So government will collect some amount of tax from those entities. Those are normally not paying anything under the normal tax regime, but now they need to pay tax under the AMT provision. Now what will happen? The assessee will complain, assessee will object. This is wrong. You have said that you will not charge any income tax from us from next 5 years, suppose. But now you are charging in the form of AMT. That is also against the income tax part. So what is the benefit of that exemption? That is a cheating with us. So department say no. If you are going to pay AMT tax in this year, we will provide you a credit like input tax credit under GST. So whatever amount of AMT tax you will pay, suppose you paid tax under AMT was 15 lakh rupees and tax as per normal provision was, suppose, 3 lakh rupees only. So we have seen in the starting of this lecture, you have to pay higher after comparing to that 15 BAC tax. Ignore 15 BAC, the higher would be 15 lakh for now. So in normal case, you have to pay to the income tax department 15 lakh. Now, assessee will say this is wrong. Why are you charging so much from me when you have said that there would be a deduction, etc. And now you have taken back the deduction. Due to that, I need to pay 15 lakh rupees tax to you. So department says, relax, this 15 lakh you are paying us, which should be only 3 lakh. So excess 12 lakh, whatever you are paying to us, would be called AMT credit. And in the next year, you can use this credit for next 15 years. This kind of discount from your tax, and you can use this discount or AMT credit in the next 15 assessment year, in the year in which your normal tax is higher than AMT tax. So in the year, your normal tax will be higher. Suppose in next year, your normal tax is 6 lakh and AMT tax is only 4 lakh rupees. So in that case, you have to pay as per 6 lakh rupees to the government. So you can claim the benefit of your AMT credit in that year. Only up to the amount of difference. Like 6 lakh was the normal tax, AMT was 4 lakh. So difference is 2 lakh. So you can utilize 2 lakh rupees from this AMT credit of 12 lakh rupees in that year. And so on in next 15 years. We have discussed all these provision in our normal class. So this was the revisionary class. In the normal class, we did not discuss that why AMT was here. So I was trying to explain the scenario of AMC that department needs to encourage development. So they have to provide some reduction on the basis of SEZ, area based, or business based, that is section 35 AD. So they have to provide. Due to those deduction, income tax liability would be very low or nil. So department needs funds for the growth of government. Indirectly, if AMT is not there, then we will collect tax after 15 years from that organization if section 10AA is there. But till 15 years, we need funds to run this country. So department say, okay, you will pay funds after 15 years. Let's do one thing. You have to pay some amount of tax over here, and we will provide the credit of that amount in the future year whenever your tax liability would be increased against AMT tax. So you can take the benefit of that AMT, what you have paid over this year. So we can run this country slowly. So that is the concept behind the AMT concept, and exactly the same concept is for MAT, what you are going to study in your final level. Chapter 11B contains the provision for levy of alternate minimum tax in case of person other than a company. Certain deduction you have to sacrifice under AMT provisions. Here is a summary how we need to calculate the provision under AMT concept. The provision of AMT, however, not be applicable, remember, to an individual, HUF, AOP, BOI, whether incorporated or not, or artificial judicial person, if the ATI does not exceed 20 lakh rupees. In case of partnership firm, LLP, etc., it's always applicable. But in case of individual, HUF, AOP, BOI, and AJP, it will be applicable only if the ATI exceed 20 lakh rupees. If the ATI does not exceed 20 lakh rupees, AMT won't be applicable. For a firm LLP, it's always applicable. ATI is irrelevant. For individual, HUF, AOP, BOI, and AJP paying tax under default tax regime section by BAC, also AMT is not applicable. Okay. Now, summary is here. First of all, find out the regular income tax liability as per normal provision of the Act. Find out ATI. How to calculate ATI? Take the income as per normal provision of income tax. Normal means as per optional tax regime, not as per default tax regime. Okay. Then if you have claimed these deduction, you have to add back these deduction. If you have claimed 10AA for calculating this income, you have to add back. If you have claimed 35AD deduction, you have to add back. You can claim depreciation in that case on that 35AD component, but full deduction cannot be allowed. After doing this, you will arrive at ATI. If ATI exceeding 20 lakh in case of individual, HUF, AOP, BOI, and AJP, then AMT applicable, otherwise not applicable. Surcharge as per surcharge provision would be there, cess would be there, and the rate is constant, that is 18.5%. Tax liability as per point number 4 we need to find out. So first of all, what we have done, we have find as per step number 1, the normal income and the tax thereon. Now as per step number 4, the ATI and the tax thereon. Now tax would be as per step number 1 or 3, whichever is higher, is our tax liability, and respective income will be my total income. Excess paid AMT can be carried forward for next 15 years as provisions of MAT. Credit can only be claimed in that year in which normal tax liability exceeding AMT. Like you have credit of 10 lakh with you. This year normal income tax is on your income is 6 lakh. AMT tax is 7 lakh. You cannot use the credit this year. Suppose it's vice versa in this year. This is 7, this is 6. You can claim and only 1 lakh credit can be utilized out of this 10. Now balance 9 lakh can be carried forward up to next 15 years. The remaining balancing year out of those 15 years. So credit can be claimed normal tax minus AMT. Tax credit allowable even if ATI does not exceed 20 lakh in the year of set-off. A person who is paying tax under default tax regime cannot claim the benefit of credit. That was the provision of AMT. We have already discussed all these provisions in detail in normal class also. Then whether you need to pay taxes per default tax regime, etc., you have to decide that. And then whatever TDS, etc., TCS you have been paid, that need to be deducted. The interest, the advance tax, etc., and then tax payable or tax refundable. Tax would be calculated at the multiple of 10 rupees. Okay. Tax planning and tax saving in case of salary, that we will take up after the break. So, Ashokji, can we go for a break? What? Thank you. Okay, welcome back, everyone. I believe you must have your tea, coffee, etc. We were discussing the provisions of computation of total income and tax liability, in which, okay, so Arin is asking something. Sir, if a question asks for agricultural income plus other income, I have to add in total income to make aggregate income and calculate tax on aggregate income and deduct agriculture income after tax. But before surcharge or cess, this is a question of BCom, please find attached. Look, we cannot answer BCom kind of questions क्योंकि उनके questions भी अलग होते हैं, उनके concept भी अलग होते हैं. Fine. I can tell you the provision, and we have discussed these kind of question, which actually belongs to our CA course also, which has been asked in the previous question paper also. We have discussed that in, I guess, chapter number 2, that was regarding agricultural income, etc. Integration of agricultural income with non-agricultural income that we have discussed. So if there's an agricultural income in the question with non-agricultural income, then listen carefully. We have to add agricultural income and non-agricultural and apply surcharge. We cannot apply cess and we cannot give the benefit of rebate. We can only give the benefit of rebate and cess after calculation of step number 1 and step number 2. Only tax and surcharge need to be applicable, if any, in the calculation of integration of agricultural income. First, we need to calculate tax on agricultural as well as non-agricultural income by applying the tax and surcharge if applicable. Then as step number 2, we have to calculate the tax on agricultural plus exempted, basic exempted limit income, considering it as a total income, and we should apply the tax and surcharge if any. Then step number 1 minus 2, whatever we have. After that only we will apply the rebate concept and the surcharge. So BCom is BCom. Okay. Next, we were discussing the tax planning or the optimization of your salary structure. Now, there cannot be any specific answer of this question. It will depend upon case to case basis, because in different kind of scenario, the structure could be changed. In some cases, we need to see what kind of facility has been provided from the employer. If employer is providing us house facility or accommodation benefit, it could be in the nature of HRA or it could be in the nature of facility, rent-free house. So we have to find out which is beneficial for an assessee. If the employer providing our car allowance, or he could also provide as a car facility. So which is benefit from the point of view of tax structure will depend upon his basic salary, his dearness allowance, etc., etc. So planning a salary or optimization of salary for the minimization of tax would depend upon various factors. What is your city of living? What is your other income? What is your basic salary? What is your DA as per terms or not? Which kind of benefit or facilities or allowances has been provided by the employer to you? Whether education facility is better for you or whether education allowance is better for you. So it could be changed on case to case basis. So for the purpose of one employee, I could design a structure in different way. In case of other employee, I would design a structure in a different way. So suppose if the income or the salary of an employee is up to rupees 7 lakh rupees, and he does not want to invest in any insurance scheme, medical scheme, etc. So I would prefer him to go for default tax regime. And if he has taken housing loan for self-occupied property, there is interest exceeding 2 lakh rupees. There are some investment in insurance. There are some medical insurance also, etc. So even if his salary is 10 lakh rupees, then I will suggest him to go for the optional tax regime so he can minimize his salary in that option. That would be benefit. Even what should be the salary package? If my client asks me that my employer is ready to pay 40 lakh rupees as a salary, so if they'll ask me that I need to design a structure for his salary, that what kind of perquisite allowances he should take, then I will ask him that you should, in respect of lunch allowance, he should go for lunch facility. So in that case, we will get 50 rupees per day benefit. In case of car allowance, and if that car allowance is that amount which is going to be utilized for the purpose of commuting, so might be his commuting cost from his office till his residences per day, suppose 1000. And if employer asking you need 30,000 rupees car allowance for a month, or for 25,000 for working days in a month, or you need a cab from a company, so I will prefer him that you should go for a cab, because in case of car allowance, that 25,000 will be included in your salary completely. But if you are taking that as a facility, as a cab which is provided by the employer, so that would not going to be taxable in this way. Or if the option is there to take a conveyance allowance in instead of car allowance, I would ask him to take conveyance allowance. So that can be exempted under our optional tax regime. So a lot of factors affect this decision that what should be the salary structure. I can only explain which component you should keep in your mind while deciding a salary structure of any employee. But which component will be fit in which case, that will depend upon case to case basis. Okay. So the definition of salary is very wide and includes not only monetary, but as well as, of course, the perquisite, the amenities, the benefit, etc. Under the default tax regime or the one section BAC, we can get the deduction of section 50,000 rupees reduction is available there. But there are multiple allowances, those are not allowable under default tax regime, which are allowable technically under optional tax regime. An employer may plan the salary structure of employee keeping in view the reduction and exemption available under the Act. If salary is paid as a consolidated amount without any breakup, the amount of salary after providing standard deduction of 50,000 would become taxable without any further exemption and deduction. Therefore, the employer may structure the salary by including various allowances, etc. So that would be more tempting to an employee. I am an employer. I decided to pay salary of 10 lakh rupees as basic salary only. No bifurcation to an employee. So I am the one who's paying 10 lakh rupees. And other employer gave him an offer of 10 lakh rupees and asked him that he will pay 5 lakh as a basic salary and some amount as conveyance allowance, some amount as HRA, some amount as perquisite, etc. So that employee might be tempted to that offer because in my case, he won't get any exemption, etc. So might be need to pay tax upon the whole amount of salary. But in that case, when he is getting that 10 lakh rupees, a certain part, 60-70% is a basic salary or a 30-40% in respect of some allowances, which could be exempt under income tax. So he might be going to that structure. So being an employer, being a CA, being a financial consultant, we have to decide the salary structure on the basis of information which has been given to us. So that has been discussed in detail already in the normal class. So employee welfare scheme. So the fund 7,50,000 is exempted up to any contribution more than that is going to be taxable. So we should keep in that mind that employer should not pay more than 7,50,000 rupees payment in that fund. So if the payment is exceeding that, so employee need to pay tax on that amount of excess. Insurance policy, etc. What kind of DNS allowance should be in his employee salary structure? That should be DNS as per terms of employment. So if the DNS as per terms of employment, that would increase the exemption regarding HRA, the exemption regarding gratuity, the leave encashment, etc. So that will be very beneficial for an employee if the DNS allowance as per terms of employment or the part of retirement benefit. So these are things we should consider. Theoretical part, you must have gone through with these provision. So now we are discussing with the MCQ. You should have a paper, pen, and a calculator with you because you have to do a lot of calculation. I will give you a question and you have to calculate and then we will solve it together. I hope you all are ready. So there is question number. Here is question number 1 for all of you. Please remember, when there is a question in which total income is just near about exceeding a limit till which there was no surcharge or a limit when surcharge limit has been changed. So always keep in mind that there could be a marginal relief concept in that question. So because in this question, I am giving you a hint that the income has been given 51,60,000. So you please keep in mind the margin relief concept and then solve this question. Suppose that Mr. X has exercised the option of shifting out of default tax regime. So that means you have to calculate tax under optional tax regime. If the income is 51,60,000 and it did not comprise any special category of rate of income because it's salary, house property, and interest income. So what should be the correct answer of this question? In the MCQs of this chapter only, you have to work a little more than me because you have to do a lot of calculation. And if you are not able to solve that, then only I will help you to solve this question. But you have to solve it yourself. So that will build your confidence, etc. And it will take time, at least 3 or 4 minutes it will take. If you have your calculator, you will able to, or if you have revised that chapter, I have asked you specially that for this chapter, you have to go through with the provision of basic concept chapter at least. So that's why I asked that because this kind of chapter will include the tax rates, the surcharge provision, the cess provision, the marginally, the rebate concept. So if you have revised that, so you will be able to solve this kind of question very easily. Arin is saying A because MRN only in 115 BAC. Who told you this, Arin? That MR is only in 115 BAC? MR in both regime is applicable. Rebate MR, that 25,000 case up to rupees 7 lakh. In that case only MR kind of concept is applicable in default tax regime, but it's not that rebate concept provision. Normal provision, so you have to apply MR provision in this also. Anyone? What is the correct answer? Let me help you. Because we have to solve this question as per shifting out of default tax regime. And because income is slightly exceeding the limit of that amount till which there is no surcharge, that was 50 lakh. So the concept or the structure to solve this question is take that amount which has been given in question and calculate tax on this. If we calculate tax on this, the tax would come 1360,500. Would surcharge be applicable? The answer is yes, surcharge would be applicable with 10%. Arun is saying answer is C. Okay, let's see. So the surcharge would be 136050. My tax on 51,60,000 rupee would be 14,96550. Now this was the tax. The cess, etc. would be applicable later. Now step number 2, we need to take that amount of income up to which there is no surcharge. That would be 50 lakh rupees. So tax upon 50 lakh would be 13,12,500. Step 3 is the difference. That would be 1,60,000, or difference of tax is 184050. So now you can see the difference of tax is more than difference of income. So that difference, which is 24050, would be my marginal relief. And this needs to be deducted from this value. So if we deduct 24,050 rupees from 14,96,550, the remaining would be my tax liability, and it would be 153,1400. After deducting, we have to apply cess of 4%. After cess, the answer would be option number C. Well done, everyone. You got the right answer. Now, question number 2. Compute the tax liability of Mr. W, age 61 years, under default tax regime, having total income of 1 crore 1 lakh for assessment year 24-25. Assume that his total income comprises of salary, house property, and interest on FD. Remember, you have to solve this answer as per default tax regime, and the age is 61 years. Remember, there is no effect of age under default tax regime, because the basic exemption limit under default tax regime is 3 lakh rupees for all individuals. So age does not matter in that scenario. Clear? So when you calculate the tax, remember this. So step 1 would be like this, that you have to calculate tax on this income after applying surcharge. What should be the step number 2 income? The step number 2 income would be 1 crore. The surcharge rate in this case would be 15%, and the surcharge rate in this case would be 10%. What is the answer? If you are able to solve this kind of question in 4 minutes, so that means you are at correct time. So if you are taking to solve this kind of question in more than 7, 8, or 9 minutes, so that means even if you are solving it correct, but your timing is really bad. So this kind of question should be solved within 5 minutes at least. So that will give you a hint that you are able to solve the question as well as in time. Because in the examination, it does not require only that the solution should be correct, but it should be within a certain time. So if you are taking a long time to solve these kind of questions, so technically you are not doing solution correctly. So solution needs correct solution as well as within a time. So Shoaib is saying that the correct answer is option A. Okay, anyone else? What should be the tax in case of default tax regime upon 1 crore 1 lakh rupees? It would be 273 0,000. Surcharge would be 409,500. Total would be 313,950. Tax in this case would be up to 1 crore 27 lakh. And 270 would be my surcharge. So 29 lakh 70,000. Pooja is saying A. Well done, Pooja. Would be this. Now the difference needs to be find out. The difference is only 1 lakh rupees in income, but in the tax, the difference is high. That is 1,69,500. So the difference between these two, because tax is higher than income, the difference of tax is higher than difference of income. 69,500 would be MR. This need to be deducted from this value and 4% cess would be applicable. So after that, the correct answer would be 3192800. I hope it's clear. Now from question number 3, the provision will change. Now marginal if concept is provision will not be there. Now our question number 3 is there and it says, Mr. A, age 50-year resident, has following incomes for previous year 23-24. Long-term capital gain under section 112. So the rate of tax in this case would be 20%. Okay. Short-term capital gain under section 111A. The rate of tax would be 15%. This is per, of course, slab rate. Or we can say person-wise. Compute his tax liability under default tax regime. Bhumika is asking, sir, if total income including income chargeable to tax under section 111A, 112 and 112 is 5101,000 or 101,000,000. So for computation of marginally, we will calculate surcharge separately for capital gain income and other income, and rest other step will remain same. Correct? Exactly correct. Very well done. It's a good question, but calculation of tax does not affect, marginally concept does not affect the calculation of tax. All the surcharge provision, all the normal tax calculation provision remains the same. Marginally just say one thing, that if your tax liability is exceeding your difference of tax liability exceeding your difference of income, so that difference would be allowed as a marginally, but yes, all step would be same. There is no difference in calculation of MR in your question also. Correct. Now the third question for all of you to solve. Let me help you to solve this question. Stay with me and understand how to solve this question. Okay, option has been here. Shoaib is saying option A, Arun is saying option B. One of you is correct, one of you is incorrect. So who is correct and who is incorrect? We will see this. Let me solve this question for you. So whenever there is a question to calculate tax, first of all, write down your GTI or TI as given in the question. In this question, the TI has been given. Shoaib saying I did not add cess. You should add, of course, because whenever there is a calculation of tax question, you have to do all the tax calculation, apply the rebate provision if applicable, apply the surcharge provision, apply the cess. Then the answer will be your final answer. Okay. So total income was 1 crore 50 lakh. Out of this income, we have to calculate tax under default tax regime. Fine. Out of this income, section 111A income is 65 lakh rupees, which has been given in question. The long-term capital gain 112 income is 55 lakh rupees. So if you know why you did not add cess, because when you find your answer and it was matching to option number A, you did not try or you did not recall the provision that I should apply cess also. So always remember, if your answer is option number A, please recheck your answer always. Because being an examiner, I will also put an answer without cess, without surcharge in option A. And what happens generally, when you calculate your tax and you find out that this answer is matching with option number A, so we generally take that answer that it is correct. No, it is very dangerous. In my opinion, if there is 10 question in the examination, out of those 10, 7 options cannot be answer A. So whenever your answer match with option number A, always recheck it. Because in 60 to 70%, that answer would be, of course, just to make you confused or just to make you to mistake in the solution. Because option A is like definitely that option in which I will put an answer which is without cess or without surcharge. So please try to solve full process of that question, then only find out your correct option. Okay, long-term cap gain. Income is 55 lakh and other is 3 crore 30 lakh. Now the tax rate on 111A is 15%. So my tax would be 9,75,000. This is 20%. So my tax would be 11 lakh. Now my income after including these income is exceeding 2 crore, but you can see my other income is without even including these income exceeding 2 crore rupees. So this is technically surcharge C case is applicable because my other income excluding these income exceeding 2 CR. So option C says now that surcharge rate would be different on these income tax. So the income including these two tax would be, and surcharge would be 15%. 311250. Always remember, a single mistake will, of course, make your whole solution zero. So please apply the surcharge rate, the cess rate, the tax rate very carefully. A single wrong calculation will technically make the whole calculation of tax, which should not be in your option. So take your time, apply the correct rate, and then find your answer. Recheck your calculation, etc. So that would be 2386250. The tax and surcharge of the special category of income. Now the surcharge rate would be, in this case, we have to calculate the tax upon 3 crore 30 lakh. The tax would come to 96 lakh rupees. And how much would be the surcharge? What should be the surcharge rate in this case? What should be the surcharge rate in this case? Yes, because it is exceeding 2 CR and the maximum surcharge rate in case of default tax regime is 25%. Very well done. So the surcharge would be 24 lakh. Tax would be 1 crore 20. So total tax plus surcharge would be 14386,250. Now that was option number A. So whenever you calculate the answer like this and you will find it out that this is my option number A, so might be you are able to tick that option. But take your time. Cess is not yet applied. Now 4% cess. That would be 575450. My total tax would be 14961,700. That option would be the correct option, and that is my option number B. The correct option is option number B. I hope it's clear. Next, question number 4. The same question as we discussed in option number 3. I have just changed that was the tax calculation under default tax regime, and now I need you to calculate tax under optional tax regime. Let me tell you, the tax on the special category of income would remain the same. There would not be any difference. The tax would on upon 65 lakh and 55 lakh and surcharge. So tax plus surcharge would remain the same in this option. That would also be 2386250. Now we just need to add the tax upon 3.3 crore rupees income under optional tax regime. That is something you need to calculate. And then after calculating tax and surcharge, we have to apply education cess, and that would be your answer. So kindly calculate tax on 3.3 crore and then apply the surcharge concept. Then add that surcharge plus tax into the tax of this special category of income and then apply 4% cess. Find out the tax on this plus surcharge. What surcharge rate is going to be applicable in this case? Surcharge would be 25%. Because if it is exceeding 5 crore, then 37%, but the income is between 2 crore to 5 crore, so surcharge rate would be 25%. So find out the tax, then apply 25% surcharge. Find out the total with tax and surcharge. Add that with the special category rate of tax, including surcharge. Then apply cess. So that would be your answer. Arun is saying option number C. The correct answer is option number C. Absolutely. Well done. Shoaib is also saying C. Let me tell you how much is going to be the tax. The tax would come 97 lakh 12,500 plus 25% surcharge. That would be 242,8,125. Total would be after surcharge 12140,625. Now adding these two things together, that would be 14526,875. Apply 4% cess. That would be 581075. So that would be 15107950. So that is option number C would be our correct option. Question number 5, we are moving on. You have to solve this question yourself. I am not going to give any hint, etc. in respect of this question. Very simple question. Mr. A, a non-resident, age 75 years, following incomes for previous year 23-24. House property is 95,000. Other sources 1,72,000. So you need to calculate his tax liability under optional tax regime. Take your time. Don't give me wrong answer. Arun is asking, income from house property is computed or not? Look, if the word is used, income, that means automatically computed. If it is rent received, that means it has not been computed. So if the word is income is there and other thing is silent, so you always consider it as a computed income. If the rent word is written over there, that means we have to deduct that 30% to arrive at the income from house property. Okay. Bhumika is saying A. Again, Bhumika, same thing happened. I told you when the answer is A, kindly recheck it. Whenever you find your answer is A, kindly recheck it. Pooja is saying D, Shoaib is saying C, Bhumika is saying A, B रह गया है कोई बच्चों B भी बोल दो तो पूरे ऑप्शन हो जाएंगे हमारे चारों. वेरी सिंपल क्वेश्चन. इसमें तो कोई कैलकुलेशन भी नहीं है जिसको गलत कर पाओ. Then why are you doing this? Arun is saying B after round off. What is after round off? I need the correct answer. It should be the D. There could not be any option after round off or not. The correct answer should be D, of course. The correct answer is D. Bhumika is saying because sir his income is less than basic exemption limit. कहाँ से भूमिका? Basic exemption limit कितनी है? 2.5 lakh or 5 lakh? Is his income is what is basic exemption limit? Is it 2.5 lakh or 5 lakh? It's 2.5 lakh. He is a non-resident. For non-resident, age does not matter. So the basic exemption limit should be only 2.5 lakh rupees, Bhumika. Why are you giving the 5 lakh benefit to him? These minute things, these kinds of silly mistake will be very dangerous in your examination. Understood? He cannot claim the rebate also because he's a non-resident. So he has only the basic exemption limit of 2.5 lakh and no other benefit. Okay. So try to avoid these kind of mistake because you all are very intelligent student, I believe, because you are connected with a teacher for 2.5 hour time. And I believe for that purpose, you need a lot of sincerity in you. So you all those are connected with me and you are trying to solve the question, you are interacting with us. So technically you are not average student. You are technically a sincere and more than average student, my belief. You might be very intelligent because we just know each other by way of this communication. So I believe with a more than average student, I believe that they should have a certain kind of smartness. If you are able to solve question that easily, that nil, don't trust yourself. It can't be that easy at this point of time. At this level of CA, now it won't be that easy to solve this kind of question. Okay. So whenever you find the answer so easily, just doubt upon yourself. Give me a second, students. Okay. Okay. So back to the business. So option, how we find out that answer? Look, the income was in this question was 2 lakh 2,67,000. And you can see up to 250, there would not be any tax. Clear? There would not be any tax up to 2,50,000 rupees. But the balance 17,000 would be taxable at the rate of 5%. So that would be 850 rupees. And when we will apply 4% cess, that was 34. So the answer would be 884 and it should be in the multiple of 10. So that would be 880. Now rebate is not applicable because he is a non-resident. So he cannot claim the benefit of rebate. Now suppose in this question, there is option number D, which is 890 rupees, not 880. Suppose the option is A, B, C, or D, and that is 890, and my answer was 884. As per the provision, we can round off it to the multiple of 10 rupees, and in that case, it should be 880. But there is no option that is resemble to my exactly correct answer of 880 rupees. So suppose if this is the scenario that we have now option A, B, C, D in the same question, and as per option D, the option is 890. So now what option you will select? What should be the correct answer in this scenario? So it might be happen in some case, there could be option which is not exactly correct. So then what answer we should select? Because in case of MCQ, sometime it happens that we have to opt that answer which is maximum correct or optimally correct. Even if there is no completely correct answer is there, then what should be the best solution or best option in this case? The best option would be option number C. You're absolutely correct. It is not 100% correct answer, but 890 would be an incorrect because the multiple of 10 could not be 890. It could be 880. 850 cannot be correct. So you can see out of even though four answers, nothing is perfectly correct, but the most appropriate answer is option number C. So if you find out this kind of options in your examination, so you have to find out the best possible or best appropriate answer. Okay. Next is Mr. Sudeep having following information. Total income is 10 lakh 11,940 under default tax regime. It has been given, and after deduction, total income is 10 lakh 1,940 rupees under optional tax regime. Calculate net tax liability under both regime. So you can assume that this income belongs to his other income category, that is a slab rate category of income. So you can calculate the tax as per the slab rate, etc. Let me help you in this. So as per default tax regime and as per optional tax regime. So the tax on 10 lakh 11,940 under default tax regime would come 61,791. The tax would be 61,791. Up to 3 lakh, it should be 0. Next 3 lakh, it's 5%. Then next 3 lakh, it's 10%. And for balance is 15%. There would not be any rebate. There would not be any surcharge. So if surcharge and rebate is not applicable, then we need to apply directly cess. 4%, that what 2472. So my tax would be 64263. Clear? Now, the optional tax regime, if I have income of 1001940, then the tax would be 113082, and again the cess 4% would be 4523. So total would be 117605. In the multiple of 10, it would be 117610. And this would be in the multiple of 10, 6, 4, 2, 6, 0. So option A would be the correct answer in this case. Let me tell you, these kind of questions is going to be asked in examination. So what we are solving is almost those kind of question which could be asked in your examination. And these minute things, that is rebate, surcharge, cess, multiple of 10 rupees, etc., that really matters in your examination. Next is question number 7. I have solved all the question. Okay. So now the Mr. Sudeep earned following income during financial year 23-24, long-term capital gain under section 112, that is going to be taxable at the rate of 20%. Winning from lottery, we know the taxability rate is 30%. Others, so it's going to be taxable as per slab rate. And we have to calculate tax as per default tax regime. So again, it's a simple question. I prefer that you should try it yourself. Let's see what is the answer. Shoaib is saying C. Anyone else? Arun is saying D. Very good. Vinay is also saying D. Very nice. Pooja is saying C. Bhumika is saying D. Okay. Again, it's a very simple question. Might be if it will come in examination, so that will carry at least 3 marks. So 3 marks question would be an examination. And I believe it should be solved within 7 to 8 minutes, not more than that time. Or less than that, I guess. Might be 5 to 6 minutes is more than enough. You just need not to do anything else. You just need to write it down or just structure your income like below. Now we are following default tax regime. What is the basic exemption limit under default tax regime? Who will tell me the answer? What are the basic exemption limits under default tax regime in this case? 3 lakh. Of course, we all know that. Very nice. So out of this 3 lakh, 270 will be exhausted over there. First one, we will give the benefit to this income. So the income would be nil. So there would not be any tax on this other income. Now, how much remaining? The remaining basic exemption limit is 30,000. Can it be used against section 112? In case of resident, can it be used? The answer is yes. We can use this 30,000 over here. So balance 5,000 is over here. That is going to be taxable at the rate of 20%. So the tax would be 1,000. Arun, you always give answer in hurry. And then you change it. So just take your time. And then try to solve the question. Okay. So the tax would be 20%, 1,000. Limit has been exhausted. The casual income is going to be taxable at 30% rate. So that would be 1,50,000 and 1,000 tax of long term. Then 1,51,000. and we have to apply 4% cess on it. That would be 6040. No rebate, no surcharge. Rebate cannot be applicable because your total income was exceeding 7 lakh, 5, 270 and 35. So rebate cannot be applicable. So now the tax would be 157040. Correct option is option number C. Understood? Bhumika, what are you writing? Tax 51 lakh plus 4%. It should be 1,51,000. You have written it 51 lakh. 5,10,000. Sorry. Okay. Next, question number 8. Now the question says, Mr. Kishore earned following income during financial year 23-24. Gross salary 3,13,000. PGBP loss from trading business 80,000. Winning from lottery 3 lakh rupees. Contribution to PPF 1 lakh rupees. Calculate his income tax liability under optional tax regime. So we have to solve this question on a separate sheet. So income information has been given. That is salary. Gross 3,13,000. That loss from business activity, PGBP trading, that is 80,000. Then there was casual income, which was 3 lakh. And there was one more contribution to PPF. That is 1 lakh rupees. You have to calculate tax under optional tax regime. If the question is silent, always consider the assessee as an individual, resident in India, less than 60 years of age. Okay, always. So now you need to calculate tax and find out the correct answer in this case. Okay. So as I always asked you, kindly always write it down whenever there is a tax question, gross total income. So in this example, you have to find it out your gross total income under different category, that is casual income. No other special rate of income except casual. Now we have only salary income, PGBP, casual income or PPF contribution. So technically there's casual income and other category income. No special rate of income is there. How much should be the other category income total is here. Can losses of PGBP set off from salary or from casual income? Is it possible or not? Losses of PGBP cannot be set off from salary income or casual. So how much should be the other income in this question? What should be the other income value in this income? Remember, the salary has been given gross salary. That means standard deduction yet to deduct. So after deducting 50,000, my salary income would be, the net income would be 2,63,000. And casual income is, of course, 1 lakh rupees. Now there is deduction also under section 80C, which we can claim because we are following optional tax regime. So 1 lakh deduction would be claimed from this category. So we would have 1,63,000 over here. Now we have basic exemption limit of 2,50,000. Out of that basic exemption limit, 163 would be exhausted over here. Basic exemption limit 2.5 lakh. So that income would be nil. We have balance left. in our basic exemption limit, if you will see, we have almost 87,000 balance left. But the basic exemption limit balance cannot be used against casual income. So casual income is going to be taxable with full rate of percentage. That would be 30,000 on 1 lakh. But there is a very tricky thing in this question. As our total income is less than 5 lakh rupees, you can see our total income is 163 plus 1 lakh. So the TI in this question would be 2,63,000 only. And because TI is only 2,63,000 and he's a resident individual up to 5 lakh rupees, he can claim the rebate of tax or 12,500 rupees, whichever is lower, and rebate is allowed from casual income also. Only rebate is allowed from casual income. No expenses, no deduction, no exemption, no set off, nothing is allowed. Only rebate is a thing which you can claim out of your casual income also. So after deducting casual income, the tax would be, it was 3 lakh rupees. Sorry, I have written it. Income is 3 lakh rupees. So that would be 90,000. So after rebate, it would be 77,500. 4% cess. So it would be 80,600 after applying cess. So if this is 3 lakh rupees, again 3 lakh plus 163, that would be 463. My TI is 463, which is less than 5 lakh. So we can claim the rebate of 12,500 rupees. On 77,500 rupees, we have to apply cess, that is 4%. And after that, we'll find out our tax, that would be 80,600 rupees. The option C is the correct option. The question change, all scenario is same. We just change that. We will just solve this question number 9 and then we will end our session within 2 or 3 minutes. Okay. Question 10 we will take up in our next session because it's a huge question to solve full calculation. So that would be taken in our day after tomorrow class. So this is our last question, question number 9, exactly the same question as we solved in question number 8. But we just have to calculate this under default tax regime. So under question number 9, if we solve it under default tax regime, the tax would come 90,000 and rebate would be 25,000 because it's less than 7 lakh. So remaining would be 65,000 and after 4% cess, this would be 67,600 rupees. So option B would be the correct answer in case of question number 9. So today we discussed the theoretical part of chapter number 9. We have done a lot of MCQs, 9 MCQs. In the next class, we will complete our 10th MCQs and then MTP question, RTP question, and previous year question. These are going to be discussed in our next sessions. If you have any query, you can ask me, or after that, we will end this session. If there is any query, you can ask me. And for next session, like day after tomorrow, again, please revise. If you do not have revised chapter number 1, kindly revise that. And kindly revise PGBP provision also. Because in RTP, MTP question, there are a lot of regarding PGBP questions. So if you have revised the PGBP provisions, that would be really helped us. That I would be really in a ease to make you understand the provisions, and you would be at your ease to understand the provision also, because we are going to solve the full question after calculating total income and how to calculate tax on it. Bhumika is saying, so please take question number 15 of study material of chapter number 9. Let me take the photo of your query. So I will solve that for you, of course. Okay, Bhumika, sure. So I guess there is no more query in this behalf. Ashok sir, we can close the session. Thank you so much, Ashok ji.